Welcome back to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, April 24th, and today's theme is simple. AI is printing market caps and pink slips at the same time.
Nothing says future of work like your job getting automated while your index fund goes up. I'm here to ask the questions your group chat is too scared to type.
First story. CNBC reports OpenAI announced GPT-5.5, saying it's better at coding, using computers, and deeper research. Finance angle. Better models pull more enterprise spending, but they also raise the bar for who captures the profits: model makers, chip suppliers, or app layers.
So it's like OpenAI just released a new espresso machine, and everyone's like, amazing crema. But investors are asking, cool, who's paying for the beans?
Exactly. Imagine AI as a gym membership for companies. The model is the gym, but the bill includes trainers, equipment, and a long contract. If GPT 5.5 boosts productivity, CFOs still want proof it reduces costs or increases revenue. Otherwise, it's just a very expensive treadmill.
But the hype is real. Better at coding hits my ears like, congrats, your interns are now a subscription. If you're a normal person, do you buy AI stocks, or do you just learn to use the tools so you don't get outcompeted by someone who does?
Both, but with boundaries. Portfolio: avoid single-name hero bets unless you can tolerate big drawdowns. Use broad tech or semiconductor exposure if that fits your risk. Personal finance: treat AI skills like a high ROI certification. Pick one workflow you can monetize in 30 days, like spreadsheet automation, customer support scripts, or code review.
Second story is the emotional whiplash one. CNBC says Meta will cut 10% of its workforce, about 8,000 people, while pushing deeper into AI. So the company is basically saying, we love humans as customers.
The finance logic is harsh but coherent. AI investment is capex-heavy: chips, data centers, power. And management tries to protect margins by cutting OpEx, which is often headcount. Markets tend to reward the combination: spend aggressively on AI, cut elsewhere to keep earnings resilient.
I'm going to push back. If everyone cuts staff to fund AI, who's left to buy the ads, the gadgets, the everything? At some point, the economy can't be all productivity, no paychecks.
Fair, but layoffs are uneven. Some roles shrink while others grow. The near-term market view is the companies that automate first can defend profits even if demand softens. The risk you're naming is macro. If job losses broaden, consumption takes a hit and multiples compress.
So for listeners, don't panic sell your retirement account because Meta did a corporate diet, but do update your career portfolio. If your work is repetitive, AI is already interviewing for your job.
Third story. CNBC says TSMC shares jumped to a record high as Taiwan eased single-stock investment caps for funds, and TSMC recently reported a 58% increase in first-quarter profit. That's fundamentals plus flows, strong earnings, and potentially more local institutional demand.
The guardrails moved, so more money can pile into the one stock everyone already loves. It's like saying, we're widening the buffet door, and then acting surprised when everyone runs to the dessert table.
And that's where concentration risk shows up. When policy changes allow higher single-name exposure, it can amplify moves both ways. Actionable takeaway: if you own a semiconductor leader, size it like a volatile asset, set a max percentage of your portfolio, and rebalance on big run-ups.
Story 4 is from SCMP. Investors rotated into China's chip makers as DeepSeek intensifies AI competition. It mentioned SMIC up 10% and Huahong up 15% in Hong Kong, while some AI application firms retreated. So the market went, apps are cute, show me the shovels.
That rotation is classic second-order thinking. When a new model ramps competition, everyone expects more compute demand. Chips and foundry capacity become the bottleneck, so capital chases the supply chain. But risks are real: geopolitics, export controls, and cyclicality in semis.
I disagree slightly. People say picks and shovels, like it's automatically safer. Sometimes the shovel makers are the most regulated, the most capital intensive, and the first to get punched in a downturn. The shovel is heavy, emotionally and financially.
You're right, and I'll reverse my framing a bit.
Picks and shovels can be lower risk only if you diversify and respect the cycle. Practical plan for this week. 1. Keep a cash buffer for volatility. 2. Prefer diversified vehicles over single names. 3. Invest 60 minutes in an AI workflow that directly improves your income. Then measure results.
And if your plan is I'll just vibe through the AI revolution, please remember, markets don't pay for vibes. Drop a comment with your biggest question, AI stocks, layoffs, or how to rebalance when something hits an all-time high.